In a few days, the next huge change that could fundamentally reshape the environment for equities, Bitcoin, and real estate might happen. If you think the market is wild today, let's just wait for what's gonna happen next. Oil prices have risen to their highest level in over a decade in the previous few days. Mortgage rates fell while property values soared to new heights. As a result of a sudden short squeeze, Bitcoin soared 13%. Earners making more than $100,000 are now exceeding negative about our economy's prospects. This is one of the most unpredictable markets that we've ever seen. And understanding a few key points could go a long way. There are some interesting forces at work right now that affect all of us as investors, and they're worth considering since what we're witnessing is starting to have a domino effect across numerous industries. Let's summarize what's happening right now. With a massive 7.5% surge, inflation reached its highest level in 40 years, requiring the Federal Reserve to boost rates to prevent prices from growing substantially higher. With Russia's invasion of Ukraine, oil prices soared due to a disruption in natural gas production. Wheat prices soared to their highest level in 14 years. Dozens of US and international companies were sanctioned, and our market began to price in the impact of international turmoil as well as lower earnings. On top of that, there was also the concern that as oil, wheat, semiconductor, and computer chip processing were being impacted, we could see even higher inflation, causing the Federal Reserve to take an even more aggressive stance on interest rates and accidentally crash the market. However, as a result of those policies, we are witnessing three significant shifts, the first of which has to do with stock prices. When the companies report earnings, they frequently provide guidance on what they expect for the rest of the year. Shareholders will have a better grasp of forthcoming earnings, sales estimates, corporate expansions, and market circumstances as a result of this. This type of guidance prompted Netflix to drop 30% overnight, Facebook to drop 26% on a warning of slower user growth, Snowflake dropped to 14%, and Zoom stock to continue its downward spiral now that people are meeting face-to-face again. Guidance has a significant impact on how corporations report to investors, and this has a significant impact on our entire market. For the first time since before the pandemic, the ratio of negative to positive guidance surged above average according to MarketWatch. And as a Morgan Stanley analyst predicted, last week's tactical rise in stocks would likely lose steam in March as the Fed continues to tighten in earnings and the earnings outlook worsens. He warns that the corporations would likely struggle to fulfill earnings estimates this year despite investor expectations. And in terms of where investors are moving their money to, is what he calls operational efficiency. These are companies who have a better chance of delivering earnings during a challenging environment, which means instead of paying for growth, potential, and defense, markets are preferring strong core businesses that have a long-standing profitable business model. Berkshire Hathaway is now outperforming the S&P 500 over a 1-month, 1-year, and 5-year time frame, serving as reinforcement that slow and steady could absolutely still win the race. Since the beginning of 2022, we've seen a shift away from digital growth and toward staid, fundamentally good businesses that were disregarded during the periods of historically low lending rates. Investors are taking a risk-off approach, according to the consensus, by playing it safe, speculating less, and focusing on companies that are most likely to record consistent profits. Although those stocks are performing well at a time when oil prices have risen, the impact of interest rates is causing another major shift in the housing market. Just recently, home price growth set yet another record with a 19.1% increase over the last 12 months, which is the highest level in the last 41 years. Experts now predict the prices could rise another 10% this year. So how is that even possible? For sale inventory remained at its lowest level in a generation in December and January. For the limited supply on the market, buyers have continued to push up prices. On top of that, we have an increase in material prices due to increasing shipping labor and supply chain expenses, a shortage of new construction due to construction delays, and as some of us predicted, a buyer rush to lock in a low rate before it rises. The reason this is so crucial is that when interest rates rise, that increases the cost of getting a mortgage, and it's generally assumed that for every 1% increase in interest rates, a buyer's affordability drops by 11%, meaning they now afford less and their monthly payment goes up. With that in mind, it's a lot better to lock in today than it is to wait. Although what's unique in this situation is that mortgage rates are largely influenced by what's called the 10-year Treasury yield. That's because mortgage-backed securities and Treasury yields are in direct competition for investor money. So when one moves, the other tends to follow to stay competitive. More investors are putting their money in a 10-year Treasury as a safe haven, as a result of the international spotlight in this case. That provides future home buyers another chance to lock in a cheap mortgage rate before they return, and they're taking advantage of it. As a result, according to recent property research, U.S. home prices will grow another 10.3% this year, indicating that underlying demand remains robust. However, don't go out and spend all your money on real estate just yet, because there have been warnings that the current rate of home price rise is plainly unsustainable. It's been said that prices will rise another 8% this year and another 4% next year. Property prices will rise in lockstep with salary growth. So if salaries increase by 9%, house prices could increase by the same amount. Now let's talk about cryptocurrency. Since last week, Russian financial sanctions have pretty much been the front page headlines across every major news outlet. And during that exact time, Bitcoin instantly rallied 13%, leading people to believe that potentially the public was turning to a cryptocurrency as a way to store their money in a decentralized asset. Although it appears as that's only a small piece in the overall picture, and instead, the sudden move upwards was the result of a short squeeze where Bitcoin went from being 52% shorted to 47% shorted almost instantaneously. Alternatively, a portion of those investors had to cover their positions during a period when roughly $254 million entered the markets, causing the price to rise, causing even more buying demand as short sellers are forced to buy the underlying Bitcoin to exit their positions, resulting in what we just saw. If cryptocurrencies are being used to fund the conflict or escape sanctions, they will very certainly be sold for another major currencies, such as the US dollar, to offset the price again. Even though the current pricing is encouraging to Bitcoin holders, with some analysts now saying that 48,000 is the next bull target, it's absolutely clear that Bitcoin is getting a lot of attention for its decentralization. So whether or not prices will continue to increase has yet to be seen. A wage price spiral that has gotten a lot of attention over the previous few weeks. For those unfamiliar, this is the phenomenon in which prices rise and workers demand more compensation in order to afford those products. Also, as their pay increases, so do the demand to buy those items, which causes the prices to go up even more. As of now, the expectations is that inflation will subside once supply chains begin working normally and more inventory is able to enter the market. But whether or not that could happen before wages increase to the point of driving even more demand is yet to be seen. For the first time since 1970s, both salaries and inflation are increasing at the same time, raising fears of a recurrence of what happened 50 years ago. Fortunately, given the Federal Reserve's active attitude to containing inflation, unlike the policies in place in the 1970s, it appears that the possibility of this worsening is low. So in the meantime, it's best to stay invested. Stick with the normal plan and carry on as usual. I hope you liked this video, and if you do, don't forget to hit the like button, subscribe, and click the notification bell. Once again, this is your Top Tech and Trades channel. Thank you for watching and see you in the next one.